Hello and welcome to today's recording. Uh, my name is Jeff Landau, residential real estate agent with Keller Williams, with a specialty of helping people that inherit homes figure out the best way to sell that when they are ready. And my guest today is Antonio Rodriquez. He is an estate planning attorney and a partner at Staker Rodriguez Law. He helps individuals and families put together wills and trusts, guides them through probate if they did not get a trust, and handles administration of the trust after someone passes away. A big part of his work focuses on helping homeowners protect their property, avoid probate, and make things as smooth as possible for families when that time comes. Antonio was born and raised in Ventura County, works closely with clients throughout the area. He's been practicing for 6 years and has extensive experience in the nonprofit world that led him to his profession as a estate planning attorney. He is definitely known for his practical, no-nonsense approach to estate planning, keeping things clear, efficient, and focused on what actually matters. Antonio is bilingual, speaking English and Spanish fluently. He is able to assist families who are monolingual Spanish speakers as well. Welcome, Antonio.
Jeff, thanks for having me. Thank you for putting this together. I'm looking forward to our conversation.
Absolutely. So let's start off with what do you feel is the biggest misconception people have about estate planning?
I think one of the biggest misconceptions is folks think uh, estate planning is for wealthy people, right? And they
Mm.
think they're, wealthy people meaning millionaires. And I think people think of these like trust funds. You hear that term, and so they feel like, okay, this is not for me. It's for somebody that is generationally wealthy, and that's not really the case. If you're a homeowner, you need a trust. It's simple as that, and that's most people.
Exactly. Okay, thank you. So I'm sure a challenge that life insurance agents have is somebody in their 30s and 40s, like maybe I don't need it yet. As it relates to estate planning, at what point should somebody realistically start thinking about their estate plan?
So there's a certain figure. There's two things that I look at primarily. One, if you're a homeowner. If you're a homeowner, especially in California, you should get a trust. It's in your best interest to get a trust. Um, Two, if you're not a homeowner, so if you do not own real estate, but you have financial accounts listed in your name only with no beneficiary, and if that account, or it could be spread, that value can be spread across several accounts, again, in your name only, with no listed beneficiary. If the value of those accounts exceeds $208,850 and something happens to you, you pass away, those accounts will need to be probated. So if you fall into that category, then you should absolutely have a trust.
208,000 and change now, did you say?
Yes, it changes every so often, every 2, 3 years, it'll change. I don't know what formula they use, but I
Exactly.
think before that was 184, 500. Before that was like 166, 250. So we'll see what random number it ends up next time.
So arbitrary.
Yeah.
Do you find that there's something that usually triggers people to get a plan in place, maybe other than buying a house, or maybe that isn't it, and something
Well,
else?
I would say most people that come through our doors are people that are thinking about retirement. So they're maybe 5 years out from retirement. Um, So usually kids are grown out of the house, or they're freshly retired. So again, same situation applies. Kids are grown out of the house. What I find is common, and this is just something, an observation of mine, is those couples are doing more traveling together. And I think they start having conversations. Well, geez, what if something happens to the both of us on this trip? You know, what happens to our assets? What will happen with our kids? How will our kids handle that? They start asking those questions, and I think that's what really prompts most people to come through our doors, is at that point. But really, like I mentioned earlier, the moment you become a homeowner, you own that home, and so title's in your name. Some people think the home is not mine yet. I still owe a mortgage. While that might be true, title is still in your name. You are still a homeowner. It's just that you owe money on that home. But if something happened to you, it's in your name. It would need to be probated along with the mortgage.
And you're finding more often than not, people are waiting that long. Like the kids are grown and even out of the house before they even start thinking about a trust.
Most people fall into that category. Yes, it surprises me. So when people that are in their 30s or early 40s that come in, I do make it a point to congratulate them and highlight the fact that they're ahead of most of their peers in this arena, in getting a trust. You know, and even within those, most of those couples that are, 30s, 40s, they tend to be public safety folks, right? So I think because
Interesting.
they're increased exposure to, being something happening to them, I think it's just perhaps drilled into them, hey, you need to make sure you're planning for that kind of thing. So most of those people that are, late 30s, early 40s tend to be public safety. Not all, but a lot of them.
Part of this is so surprising to me that people can wait so long, yet, we hear about like people in the public spotlight that have passed away that have multi millions of dollars and never had a trust.
Yes.
Uh, and I've heard, you can please let us know, something like 30% of people that should have trusts actually do, and 70% don't. Have you heard numbers like that?
I'm not too familiar with those
Okay.
numbers, but I do think. I mean, I wouldn't disagree with you based off my observations. Um, a lot of people don't have it. A lot of people don't realize that they need it, and oftentimes when we're talking about a couple, and if they own the home together, um, they usually vesting on the title to that property is usually, husband and wife as joint tenants. Um,
Ooh,
that's
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 no good.
that's a common vesting that I see. And what happens in that situation is sometimes one spouse dies, and that's a significant life event. And if they haven't made their own estate plan at that point, that's usually what will trigger them to come through our doors. And when you have property owned jointly that way, probate is still avoided because it's held by husband and wife as joint tenants, and so um, they kind of dodge a bullet in that sense. However, vesting can be in different ways, and if, for example, to contrast that joint tenancy, you can hold property as a tenant in common, and that's more typical when you have, let's say, a business venture with somebody else, and let's say you own real estate with that other person. When you hold it as tenants in common, um, if you pass away, your ownership in a tenancy in common stays with you, stays with your estate. So if you don't have any kind of planning, your interest in that property that you held as a tenant in common would likely need to be probated. Whereas a joint tenancy, if you hold property with your spouse, with any other person, and you hold it as a joint tenant, if you pass away, your interest automatically goes to the remaining joint tenant or tenants if you have more than one or three. Um, Automatically, just by operational law, it goes to the other people. It doesn't stay with your estate. Um, so a lot of times, probate is evaded or avoided when you have couples and one of them have passed away. Because oftentimes, that kind of significant event is what will also bring people through our doors.
Okay. So we're going to get into a little bit later, we're going to get into other documents that are in a trust. And we're going to talk more about trustees. So after someone's passed. However, before that, what mistakes do you see homeowners make over and over that hopefully after they listen to this, they can address?
Well, I would say something that's kind of common, um, well, fairly common, is homeowners who have children will add one or two of their children to title of their property, thinking, hey, if we die, our kids are already on title, no need for probate. And while that is true to a degree, most people don't understand the consequences of doing that, right? If let's say you have four kids and you add one of those kids to title, and let's say you make them a joint tenant. So now that child is on there with you and your spouse, and you tell that child, hey, child, when we're gone, this house is for you and your siblings, share and share alike, split it amongst the four of you. Uh, Parents pass away, that one child who was added as a joint tenant, remember what I said earlier, becomes 100% owner of the entire property. It avoids probate, but the owner is now the child. And so at that point, the child can share it with their siblings or not, and they can keep it and it's theirs. And the other children have very little to no recourse in correcting that problem because parents during their lifetime added one of their children, that child, to the title of their property. And that's a huge no-no. I mean, aside from that being able to happen, other things is you've made that child a homeowner. If that child is now in some kind of legal trouble and is being sued, they're an owner of that home. If that child is in a relationship and is married and is getting divorced, you're possibly putting that part of your property in within that divorce. There's so many, and then there's a negative tax treatment. So let's say you have your child is trustworthy and honors your wishes and says, okay, my parents added me to title to share this home with me and my siblings. I'm going to honor their wishes. We're going to sell the property and I'm going to split the proceeds between me and my siblings. Let's say they do that. Because you, as a parent, during your lifetime, added your child to the property, you also transferred your tax basis of that property to your child. So the tax basis is usually what it cost you to acquire that property, right? So if you purchase that property, let's say I'll use my parents as an example. They purchased the property in the mid '90s. They purchased it for I think 220,000 here in Camarillo. That same property is worth about 900 $1 million. It's appreciated substantially. Their tax basis is very likely 220,000 what it cost them to acquire that property. If they transferred it to me during my lifetime and told me, "Hey, Antonio, share it with your siblings," and I do that and I sell the property because I'm going to share the proceeds, I'm going at the time of sale, I'm going to have to calculate a capital gain and I'll have to pay a capital gain tax. And so the calculation, let's say I sell it for $1 million after my parents have passed away, my capital gain would be the difference between $1 million and $220,000. And that difference, which is $780,000 of gain, is taxed at about 30%. So I'd pay close to probably 22,000, $220,000 in capital gain tax, all because my parents added me to title because maybe they didn't want to make a trust and avoid probate. So they met one goal, they avoided probate, but I'm sure they didn't. Their intention is not to have me pay $220,000 in taxes, right? And the
Yeah.
cost to kind of contrast that with the cost of getting an estate plan, it's pennies on the dollar in comparison.
So costly. Wow. That's
It
really
is.
good
So,
advice.
there's a lot of easy ways to go around things, but most people don't know the consequences.
So you mentioned even in your case, you have siblings. What what are the negatives of now, we talk about your parents and choosing the successor trustee. What are the negatives of choosing multiple trustees as opposed to just having one?
The negatives are um, now you have two people that need to coordinate to be at the same place to get things done, to be at the bank, to open up a joint account because you're co-trustees,
Hmm.
to if you're going to sell the real estate, for both of you to be present with the realtor when you're signing the listing agreement. And there's ways around that. You can e-sign things nowadays. Um, but you need two people to make decisions. What if those two people reach an impasse? What if they can't decide what to do? One has one opinion, the other has a different opinion. And now they can't decide. Um, Now that creates problems. Now maybe to overcome that impasse in an extreme situation, you have to go to court. And now the court will decide for you if you can't agree to it.
Hmm.
Um, and I do have ways to plan for that because some people do insist on having co-trustees. Uh, but generally, I like to just tell me one person because after you give me that name, I'm going to ask you a follow-up question and I'm going to ask you, well, what if that person, in the event that person cannot do it, give me a backup so that if the first person cannot act, the second one can. And a lot of times I find maybe folks don't have a complete understanding of what that trustee role is. Sometimes folks will say, oh, well, I want all my kids to be trustees when they're going to make all their children beneficiaries. And I say, well, you already listed all your kids as beneficiaries, equal parts to all of them. You only need one of them to do this job. And this one person should be the most trustworthy and recognize you're leaving that one person a duty. You're leaving them with a job. The rest of the beneficiaries, they're kind of just hanging back, waiting for that one person to do their job. Um, and so I think a lot of times people think, okay, well, I don't want my other children to get offended that I didn't choose them. And, that's really not the best way to think about things.
Yeah, and in my family, my parents, there I have two older sisters. My parents named the middle sister the trustee. She went to law school, so they felt, comfortable with her. And then there was a falling out between my dad and I, and he said he's going to teach me a lesson. He's going to make both of my sisters co-trustees. And I'm like, well, the joke was on him because he took any kind of pressure off of me and put it
Mhm.
all on them. And
Yes.
they're really different people, different ways they run their lives and how they organize strengths and weaknesses. And he he really he didn't accomplish what he wanted to and didn't serve that purpose. Fortunately, we all got along. There were no issues, and we each
Mhm.
divvied things up anyway. But that's a that's a thing to keep in mind.
It is. I've had situations where I represent a co-trustee and now their sibling co-trustee has their own representation. So
Mhm.
now the trust has the expense of having to pay for two attorneys because these two siblings don't get along and they were both named as co-trustees. and now everybody loses in that situation because of the expense. Everybody but
So,
the attorneys, really.
so what happens when you have either co-trustees or one trustee but beneficiaries, and some want to sell the house? Let's just talk about the real estate. Let's narrow
Mhm.
down the
Sure.
conversation. The parents have a house or multiple houses, and the beneficiaries, let alone the trustees, but the beneficiaries, some say don't sell it, some say do, or if there's co-trustees. What have you seen? How do those things get handled?
So typically, if any one beneficiary wants the home sold, it's going to be sold. That's typical. However, um, if that's the direction it's going in, if any other children, because typically children are going to be the beneficiaries of the trust, right? So if other children beneficiaries don't want to sell the home and they want to keep it, then what is typical is an offer is made to say, okay, well, if you don't want to sell the home, do you want to keep it? And if you want to keep it, are you able to purchase the shares of those or the interest of those that don't want it? And if you are, then okay, the home won't be sold out in the open market and you'll be able to keep it, but you're going to have to pay out your siblings, right? And so that's usually what happens. And sometimes when people have that thought, don't sell, but can't purchase it, then what's likely is that it will very likely be sold. I generally do advise folks, you know, sometimes parents say, I don't want the home sold. I don't want the home sold, and I want my kids to own it together. Uh, there's 3, 4 kids. I do mention, if you're asking your kids to all own a home together, you have three, however many children you have, 3, 4 opinions on how to manage that home. And now, if they're married, well, now their spouse is also, in
Exactly.
their ear telling them this or that. So, really, you have 8 people, if you have 4 children, 8 people really trying to manage one property. That's, I say, that's like a guaranteed fight. You're running the risk of your children ruining their relationship.
Yeah.
It's best for them to make that decision whenever that date comes. And if they want to keep it, then let them make that decision. And if they want to sell it, then they can sell it.
So if we focus on the trustee now, what are the most important things for a trustee to know, understand?
So they should understand that they hold a fiduciary responsibility, meaning they are going to be managing and controlling assets that other people are entitled to. They might, if they're a child and they're a beneficiary, they're wearing 2 hats here. They are entitled to a portion of the trust, but they're the trustee. So they're wearing 2 hats here. And when you have that fiduciary responsibility, you have an obligation to the beneficiaries. So if you breach those duties, that at any of your fiduciary duties, then beneficiaries have recourse. And you can be, as a trustee, you can be held personally liable for breaching a duty. So it's important to realize the responsibility. Yes, you're handling your parents' property, but your sibling beneficiaries have rights too, and you have certain duties and obligations to them. And if you're not meeting them, you can be in a lot of trouble if you're not meeting them. An example is being aware that you should be providing an accounting to the beneficiaries. You have to show them what you've done with the assets since you took over, since you stepped into the role of trustee. Um, and realizing your power. So usually it's really a great idea. This is what trust administration is. And so, as you mentioned, we do offer trust administration services. At that point, why would a person want to hire us? It's to protect you as a trustee. So we will represent the trustee to protect you as a trustee from personal liability. Make sure you're doing the things correctly. Um, because We've had situations where a person started off doing things on their own, they got stuck, problems happened, and now they come to us, and now we're having to undo things and correct things. And now that person is spending more in trying to, clean up whatever mess they made and then finish up from where they left off. And that ends up being a greater expense than if they had just hired us from the beginning. Uh,
Is it really possible, other than somebody who is an attorney that has had training, is it really possible for a trustee to know what all of their duties are and actually follow through on all of them as a trustee to unwind somebody's trust?
yes, I mean, but realistically, is the average person going to know and be aware of all those duties and responsibilities? Probably not. Probably not. Sometimes people think, okay, well, my parents got the trust done. Why do I need to come back and see you? Like, this is all done, right? Like, no, no. The trust was set up so that when parents pass away, now the trust at that point, so we're talking about a living trust because there's several different kinds of trust, but
Yeah.
the most common is a revocable living trust. Well, when the creators of that trust pass away, that trust will become irrevocable. And that sets off certain duties to the trustee. And if they're not aware of that, they're delaying things. There may be something that happens is I'll have a child call me and say, hey, my parent passed away 5 years ago. They had a trust, the home's in the trust. We didn't do anything, but now, we're thinking about selling the home. Um, well, now 5 years have passed since your parent passed away. The county assessor was never notified. So for these 5 years, you've been paying property taxes at what your parent should have been paying. And what happens when a homeowner dies and now children inherit that property, even though you haven't officially made that transfer so that you as a child are on title, there is a change of ownership that happened. Right? When the parent passed away, they were no longer the owner. And now the children had a right to that. That's a change in ownership. And so what happens with the change in ownership and property taxes is that the county assessor will assess that property and now redetermine property taxes. So now that child 5 years later is going to be hit with an escape assessment for that difference in property taxes that hadn't been paid for 5 years. Now they're going to get surprised with this huge tax bill because they thought everything was fine and dandy. And people don't realize that, and people um, should really take the time to inform themselves because it is an expense, but with us, the expense is in your best interest. It's gonna, there's potential to save lots of money. I mean, that's just one example, but several different things can happen.
And for those people that don't know, the trustee needs to understand probate code in order to properly administer the trust.
Correct. Yeah, probate code is what the law that they're following. And there's a lot of laws that apply to trusts. Um, that are triggered when the owners or the creators of the trust, typically called settlors, trustors, grantors, when those folks die, uh, the trust is now placed into a different category with different roles, and that trustee, the successor trustee, should really be aware of those to make sure they're doing their job correctly.
Exactly. So let's say parents just came, sat down with you, created a trust. They have a couple of kids. They name one of them the trustee, or I guess successor trustee. What, if anything, should that successor trustee do day one when the parents say, "Hey, we just signed our trust, and you're the successor trustee"?
Well, I think it's up to the parents. Sometimes folks don't want their children to know that they made a trust, or at the very least, they don't want the children to know its contents. But we do typically make copies of the estate plan, which we'll get into in a second. But the estate plan is composed of four documents. You have a trust, a will, financial power of attorney, medical power of attorney. Arguably, your most important document will be the trust, but the entire estate plan, we will make a copy of those documents. We'll provide a letter to the successor trustee. We'll put it in an envelope. We'll give it to the clients and say, "Hey, this is for your child, who you've named as the successor trustee. There's a letter from me that basically says, hey, you're it. If something happens to your parents, give us a call." And that way, they have at least some sense of direction on what to do, who to contact whenever that date comes. We also give our clients a binder, and I will describe that binder as our playbook, or the child's playbook. That binder should have all the information that the child, the successor trustee, will need to carry out the terms of the trust. They need to know where you have your bank accounts. They need to know if you have retirement accounts, where they're held at, who the beneficiaries are. They need to know if you're going to gift items of personal property to people, because a lot of people don't think about your personal property. And I'm talking furniture, jewelry, vehicles, all those little things are property that needs to be divided. And sometimes if you know that, more than one child wants your wedding ring, for example, and you know who you
Exactly.
want to give it to, you want to specify who you want it to go to, because you don't want them fighting over that once you're gone, right? And so that binder should have all that information, so the successor trustee doesn't have to go on this wild goose chase just trying to track down your assets. So those kinds of things, setting those things up while you can, because your child is going to use that binder when you're no longer here. And they're not going to be able to turn to you to ask you questions. And that binder should have all that information.
Mm. So let's fast forward. The people that have made the trust have passed away. The successor trustee is now the trustee. Other than what I'm going to say, I would recommend step one is to hire you to administer the trust. But what are other steps that they should do to help make administering the trust a success?
They should keep everybody informed. So again, typically the distribution is going to be to the children. That's the most common. It doesn't always have to be, but I'll describe what is most common is that children will be the beneficiaries of the trust. And so and also what's pretty common is that a child will be the successor trustee. So I do recommend they should keep an open line of communication, maybe make a group text with all the siblings to just keep them informed. Hey, I found dad's account here. This is the balance. Here's a copy of the statement. I found mom's things here. Here's a copy of this. Keep them informed so that they know what you're doing. They're aware of what you're managing. And if you're keeping them informed that way, then it's it increases the likelihood of things going smoothly. People just want to know what's going on. And when you're not telling them, or when they're kept in the dark, that's when they start to wonder. That's when maybe problems start happening. So it's really just keeping an open line of communication with the beneficiaries, and communicating with your attorney, whoever's helping you administer the trust.
And do you see common mistakes, maybe some that, I guess common means that they just keep on coming up? A two-part question, and then one of those mistakes that are easy to avoid.
So sometimes what people do, a successor trustee will do, is they'll make distributions when perhaps it's not the best time to make a distribution. So, for example, when a living trust, a revocable trust, becomes irrevocable, and again, what's common is it becomes irrevocable once the makers of the trust pass away. When that happens, the trustee has a duty and obligation to send the beneficiaries, again, which are going to be their siblings, official notice that their parents had a trust. And a lot of times people discount that because they're going to say, well, of course, I know my parent had a trust. Of course, my siblings know that our parents had a trust. Like, why do I need to tell them that? Of course, they know they died. Why do I need to tell them that? Well, you need to provide that specific notice, and in this notice, those beneficiaries, your siblings, need to be informed that they have 120 days if they chose to contest the trust to contest the trust once you send them that notice. If you never send them that notice, it's like you're leaving that door open indefinitely.
Never
And if
started.
ever down the road they have a problem with how you did things and they never got notice, or maybe not that you did things, but maybe they have a problem with what the trust says, you're exposing yourself to now a sibling contesting the trust, taking it back into court, bringing you in there because now you're the trustee. And if this happens early on, let's say you made distributions, then you made the notice, gave the notice to the beneficiaries, and a problem happens. Well, now those distributions that you made beforehand, you know, that might compromise whatever issue came up because somebody's contesting the trust, right? So there's a certain way to do things, and if you're not doing them correctly, you're opening yourself up to just a lot of risk and consequences.
Not sure if there's a certain window of time. What are some of the first things that a trustee should do when that second, if there were two people, the second has passed away, now they go from successor to trustee, now they have to administer the trust. And we may have, we probably covered them, but just from a timeline, not actually number of days, but what do trustees need to start doing in those first couple weeks, first couple months?
So they should just be aware of the assets that they're going to be managing. So, after they've hired an attorney, they should be going out to the financial institutions to notify those places that, someone's passed away and they are the successor trustee. So they are now wanting to gain access to those accounts. And so they need to start going to all those places to gain control of the assets. So that's probably one of the first things, making sure if there's property, being aware, is there a mortgage on there? Or should I continue paying the mortgage? Um, are there services, are there regular recurring uh, costs that are being, auto charged or auto billed onto the parent's account. Being aware of those things and just knowing what you're going to do with those automatic charges and just making sure that unnecessary expenses uh, don't occur and just getting a good handle on the lay of the land so that you know what needs your attention first.
And as a public service announcement for everybody, assuming that the parents owned a home and then nobody's living in it after the second parent passes, you need to speak to their insurance agent, let them know, and you'll very, very, very likely need to get a vacant home insurance rider because there's extra risks to the insurance company. And if you don't let them know, and then there's vandalism or some other kind of loss that may affect coverage for the house.
Right. So it's like those little things that most folks don't know, right? They just kind of do it on their own and running risks.
So what happens if again, so the second, let's just say second parent passes, successor trustee is now the trustee. On day one, day two, they say, you know what? Before I let the bank know, maybe I should take out 10 or 20 grand, 30,000, just for any expenses that come up. I won't have to worry about whether I'm going to not have access to the money. Then after I take the money out, I'll let the bank know. Is there a risk to the trustee for doing that?
They can run a risk if they're not managing that money appropriately. And this goes back to just keeping everybody informed of what you're doing. And if that's something you choose to do, make sure the beneficiaries are okay and aware of it. Um, the safer bet sometimes is there's valid expenses that should be covered by the trust. And sometimes if you don't have immediate access to trust assets to pay for these expenses, for example, for us, we require a retainer to begin trust administration services. If you don't have access to your parents' accounts, this is a trust administration, paying for that is a trust expense. If you don't have access to your parents' accounts, you can pay for it out of your own pocket. Once you gain access to the trust accounts, you can reimburse yourself for what you paid out of your own pocket. Right? So there's ways around it, and so a reimbursement looks a lot better than not telling your siblings, "Hey, I went in there, took $10,000 cash out, and I used some of it to pay bills, and the rest it's in my bank account." And now you've commingled assets with your own funds, and that can be problematic,
Hmm.
right? So a lot of times it's just better to pay for it out of your own pocket or any other beneficiary for that matter. It doesn't have to be the trustee, but whoever's paying out of their own pocket can be reimbursed later.
Okay. So let's say a trustee, even though they're hearing you and I recommend that they engage you to help them administer the trust, let's just say they go, okay, great, appreciate the advice. We're going to try doing it on our own. Have we covered what risks that they take? Is there like a worst case that you could share if somebody doesn't do something according to what code is?
Um, I mean, worst case, there's a lot of things can happen, but I, common things is they do nothing. They don't administer the trust, right? And now, the county assessor isn't notified, like what I mentioned earlier. Property tax issues now come up because when they finally do decide to do something about it, and time has gone by, and they're told, "Hey, by the way, did you ever let the assessor know that your parents passed away?" No. Okay, well then property taxes are going to go up for that length of time. If it's been 3, 4, 5 years since your parent passed away, they're going to go back that far and change the property taxes. And if that happened because they chose not to hire an attorney, you're going to start looking at other things that maybe uh, might have happened by not being aware of what you should have done. Um, there's, there's just so many things that can happen.
Okay.
But I would say that's a typical one is that they don't do anything because they figured, okay, well, the trust was made, all is good.
So, like in this circumstance, you gave just an example. The trustee doesn't do anything for 5 years. And just so our listeners can get a sense, with the $200,000 house, Prop 13 has a limit on how much property taxes can go up each year. So let's even say property taxes double to 4,000 a year. But now the property's worth a million when the parent died 5 years ago. So now they should be paying 11-ish thousand, rough guess, as opposed to
Hmm.
the four. So that's 7,000 that didn't get paid to the county. 5 years later, that's 35,000. I'm going to guess the county's maybe going to add on a little penalty and interest. I'm just guessing. So let's even say that 30, it's 35, it's 40,000. But the trustee thought they were doing their job day one. Like, look, mom and dad had this cash in the bank, so everybody gets it because one of my siblings is short on money. So we're just gonna empty the account. Everybody gets that. Maybe sell a couple stocks, liquidate any of that. All right. Now, 5 years later, the county comes back and sends the trustee a $40,000 bill, but they've liquidated the assets. Is the trustee alone legally the only one on the hook to pay back that money to the
They,
county?
they may be held personally liable. They may be held personally liable. And that's another thing where, when we help people with trust administration, we tell them, expect this supplemental tax,
Right.
um, hold a reserve. So you're going to distribute out virtually all of the assets, but withhold a reserve. You hold on to that because in the future, there's going to be future trust expenses. It's a lot easier to hold a reserve than to ask beneficiaries for money back that you already gave them because maybe they already spent it.
Right.
Right. So you withhold a reserve, you cover, the common things would be the decedent's final income tax return. Perhaps you filed the trust income tax return, um, a supplemental property tax. Because if you sell the home after your parents pass away, property tax will be factored in during escrow, but not the supplement. And
Right.
you're going to get the supplement sometime. In Ventura County, I've seen in some cases, it takes 2 years before you get the supplement.
Wow.
And when we know that it's going to happen, it's only a matter of time. And we've told our clients, withhold a reserve. When they have that reserve, they get the bill. They say, oh, okay, this is what the attorney was talking about. Good thing I have the reserve to pay for it.
Ventura County could be 2 years, so that means LA could be longer than two.
I think Ventura County, there was a point in time, if I understand correctly, they within their offices they were changing systems that
Okay.
caused the delay.
Oh,
So I think
okay.
it's not typical for Ventura County to take that long,
Okay.
but what can be typical is let's say a year.
Okay.
LA County might be a year, um, but you have to be aware of that and account for that. You want to be able to have immediate access to pay that property tax bill, that supplement, because good luck getting it from the rest of the beneficiaries.
Right. So having reserves are really, really
Yes,
important for the trustee to do.
it's an important thing because once you've done virtually everything, there are still a few things typically that need to be done and are an expense, and you should have some
Right.
assets, some money to pay for those expenses.
Back in the day, there was a popularity with AB trusts, and something happened, some legislation, we don't have to get into it, but legislation came and for the most part, it made AB trusts not necessary. Though you and I were discussing, especially with blended families, AB trusts are useful. Can you please explain that? So some of our listeners are going to have blended families, and this will be
Sure,
important for them.
sure. So to kind of touch on the first part that you mentioned, a big reason that AB trusts were popular years back is correlated is tied to the estate tax, um, federal estate tax. So just point of clarification: the state of California does not have an estate tax, right, or a death tax. There is a federal estate tax, and there is an estate tax exemption amount. So the federal government will exempt a certain amount of assets before they impose the tax. So today, 2026, the exemption amount is 15 million. So for you to have an estate tax concern, you should have more than $15 million. So that doesn't apply to most people, right? I don't know very many people that have that kind of money. So an AB trust, because of that, because you're in a state tax territory, yes, it's not common. However, that AB trust for a blended family, it has another function for those blended families. So an AB trust, and I'll go back to before I start explaining that, we live in California. We're a community property state. So the presumption is, and this is absent any kind of agreement, whatever a couple earns and acquires during marriage, it's presumed to be community property. So, for example, if you both of you work, doesn't matter who earns more, you pull those earnings together, and each of you are entitled to half. If you acquire property during your marriage, it's community property. Each of you have a right to have. So, with community property, each spouse gets to control their half at death. Right? They can say, "Well, my half of community property goes to these folks." Um, in a trust that I refer to it as a simple trust, and I call it a simple trust because it's a joint trust that you make with your spouse, and the trust says, "Well, when the first spouse dies, the surviving spouse stays on as a trustee, as a beneficiary. The trust stays as one single trust." And what that means is that when the first spouse to die, when that happens, their half of community property automatically goes to the surviving spouse. And now the surviving spouse controls all that property, right? And when you have a situation when all of your children are from the both of you, you shouldn't really have that worry that you're going to disinherit your kids, or that your kids are going to be disinherited because your surviving spouse is also their parent, right? So a simple trust, that makes sense in that kind of situation. But if you're in a blended family, now you have children from prior relationships, you may not think that way necessarily. And so with an AB trust, it's a trust that starts off as one joint trust when the couple is alive. And the trust says, well, when the first person dies, this single joint trust is now split into two new trusts that will be formed. And one trust, there's several different names for these trusts. They can be referred to as an A trust, B trust, as a survivor's trust, exemption trust. The exemption trust can be called a bypass trust, several different names. But the key thing here is the first spouse who dies, their half of community property gets placed into a new trust, which is irrevocable. Oftentimes it's the B trust. And because it's irrevocable, no changes to beneficiaries can be made. So that spouse who chose their child from a different relationship as the beneficiary, that cannot be changed by the surviving spouse. The surviving spouse is still the beneficiary of everything. So that deceased spouse's child, they're not receiving an inheritance at this point because the surviving spouse is alive. The other half of community property that is belongs to the surviving spouse, their half goes into a separate trust, oftentimes called the A trust. And because the surviving spouse is still alive, their trust is still revocable. They can still make changes, right? So if they enter into a new relationship, they can make changes to the beneficiaries of their A trust, of their half. The beneficiaries of the B trust remain the same. So it should give you, if you're in that blended family situation, it should give you, as a parent of a child who is not your spouse's child, should give you the peace of mind that your child is not going to be disinherited by your surviving spouse. And that's where an A B trust comes in handy to protect your children's interests.
So with that B trust, it seems like it could be worded this child, this person gets X percent of my assets or gets $100,000. Because if they say a certain person is, well, I get, is there a way for the surviving spouse, if they don't like the irrevocable B, how
Mhm.
that's worded, is there a way to like not allow assets to flow to it? I guess even if it's a dollar or a percent after the second spouse passes, they can't like
You
spend
have
so much that there's nothing left for that person.
so what you typically do is that you get a snapshot value of what the trust holds when the first spouse dies. So you have to initiate some trust administration, and you have to find a value to that trust effective as of the day that first spouse dies. So if you have if the couple holds real estate and a few bank accounts, and let's say that adds up to $3 million altogether, then you can say, okay, $3 million of community property, half of that is 1.5 million. So you allocate 1.5 million dollars of assets into this B trust, and then the other 1.5 goes to the A trust. And so now you've kind of earmarked the B trust to say, okay, it's 1.5 million. Um, the beneficiary of that B trust is still the surviving spouse, but you've really locked in the beneficiaries of that B trust. And that beneficiary would be the deceased spouse, the first spouse to die. It would be their children, which can be joint children between the spouses, and children from a different relationship. The key thing there is the surviving spouse cannot make changes to the beneficiaries of that trust.
All right. Okay. So, assuming somebody had their trust done a while ago and they want to get them updated, they're meeting with you. Have you come across common problems that you've seen with trust documents in that case?
I've seen problems where the person has an AB trust, one spouse has died, and they want to make changes to the trust, and they don't realize that they have an AB trust. And they don't realize that the changes that they want to make
Oh,
can't be made how they were thinking about them because of the joint trust of the AB trust they created years back with their spouse when their spouse was still alive. And sometimes that does surprise people because they never initiated trust administration. They were never aware of the type of trust that they had. And a lot of times, folks don't. It can be a pretty complicated thing to go over trust, and sometimes I've seen some trusts that are 60, 80 pages. Um, Oftentimes has a lot of, in my opinion, fluff, um, and it's an overwhelming document to just even think about for most people. And then when they kind of muster up some courage to make changes and do things, and they realize, hey, I can't make the changes that I wanted to make because of the type of trust I had.
right.
Um, so that happens. Um, I really try to guide people. A lot of times, people, the dynamics within a family. If you've been estranged from one of your children and you don't want to leave them something, you can do that. But sometimes it's not always as easy as one would think because you can disinherit somebody. The concept of trust to transfer assets at death is a fairly newer concept. Before that, everything was done by will, and a will must be supervised by a court, by a judge. Um, and certain rules apply with wills. Well, when trust began to be used, um, a lot of those rules that applied to wills also now apply to trusts. So one of those rules is that notice that I mentioned earlier. The trustee must notify all beneficiaries and heirs that the person who died had the trust and the trust became irrevocable. And so now what's the difference between a beneficiary and an heir? A beneficiary is anybody you choose. You can choose anybody to be a beneficiary. An heir is more like your blood. It's your child. So you can not make one of your children a beneficiary, but they will always be your heir.
Right.
And because of that, they would be entitled to receive a copy of the trust when you pass away. And they would be able to see that you disinherited them. And at that point, because they're an heir and they got that notice, they're told, hey, you have 120 days to contest the trust. If they chose to contest the trust, simply because they're your heir, they would be able to do that. And they can say, well, my other siblings unduly influenced my parents to not leave me anything, however true or untrue that may be. Or, if the parents made a change to the trust to disinherit them and the parents are, in their 80s, the child can say, well, my parents were in their 80s. They didn't know what they were doing. They didn't have the capacity to understand what they were doing.
Right.
You're just you're opening up yourself to that kind of exposure, and there's ways to prevent that. And so I do like to advise folks, on ways to prevent that because you know you're coming to me so that I can advise you and give you the peace of mind that you're doing things correctly, but also give you the peace of mind that when you're gone, your children and what your plan is going to be put in place with little to no problems. And so you're paying for that advice uh, to do things correctly.
And how are we doing on time?
Um,
That'll limit what kind of questions we can follow up with.
Let me check really quick.
Yeah.
I have about another 5 minutes.
We'll keep, all right. Okay. Uh, how does Prop 19 impact inherited property and the planning that you do for families?
Okay, good question. So Prop 19, to clarify, only applies to the parent's principal residence. And what Prop 19 is, it's an exception. I like to say it's an exception to the general rule. The general rule is that whenever there's a change in ownership of real estate, property taxes are going to change. The property is going to be reassessed, and property taxes are going to be based off the new reassessed value. So when a homeowner dies and children inherit, that is considered a change of ownership. Prop 19 is the exception, and Prop 19 says, hey, if the transfer is from a parent to a child, and we're talking about the parent's principal residence, the child can keep the parent's property tax liability the same as long as that child now makes the parent's home their new principal residence. And if that happens, the child can keep the same property taxes that the parent had. They in a way inherit the property taxes that the parents had, rather than pay a reassessed higher property tax. Um, and so that's a great benefit. And a lot of times, usually it's going to be one child that wants to do that, and that child will think, okay, well, I'll just buy out my siblings, and I'll keep the home, and I'll pay them out their share. You can do that, but if you file Prop 19 and they look at that, they're going to say, well, you bought out your siblings, so the portion that you bought out, that's a sibling to sibling transfer. That's not a parent to child transfer. So if you have four children and one of those children wants to keep the home, they can keep property taxes the same. They can file Prop 19 as to their 25%. Because every person's entitled to 25% if they're four equal beneficiaries. You can keep and preserve your property taxes on 25% of the property. The other 75% will be reassessed because you bought out your siblings.
Wow.
And so there's ways around that, and we can
Okay.
plan for that.
Okay.
You know, and that's where people think, okay, well, Prop 19 is great. I'll do that. That's super easy to do, but they're not aware that you know if there aren't enough assets to make an equal distribution of the entire house to that one child,
Right.
chances are portion of that property is going to be reassessed. And people don't realize that.
Wow.
And, when they don't do that and they don't realize it, we're talking about thousands of dollars per year that property taxes will increase if it's not done correctly. So it's very important, I think, and it's very much worth the expense to be advised on how to do that properly. I've seen situations where, doing this Prop 19 planning, the child is saving $5,000 per year in property taxes because they reached out to us beforehand and we helped them out and helped them do it correctly. $5,000 per year for however long they're going to live in that property.
That's a lot of money. That's
It's a
awesome.
lot of money. It's a lot of money, and it's, in my opinion, obviously it's a biased opinion, but it's worth every penny.
You bet. All right. Before we put a bow on this, what's one simple step someone can take this week, or what's something that you want listeners to uh, take away from our time together today?
Estate planning. A lot of people don't like to talk about it because you're kind of talking about death, and while yeah, that's a factor in this discussion, you're really giving yourself the peace of mind that you're doing something so that when you're gone, you should have the peace of mind that things will be in place to make your kids' lives easier. It's not really as painful as you might think. I will complete the job over the course of two meetings. The first meeting is a consultation, free. There's no cost. So all you need to know really is who are you going to name to be in charge and who's getting what. That's really the two things that you need to know before you come to talk to an attorney to do your estate plan. Um, but it's not as bad as most people would think, and it's giving you the peace of mind that your children are going to be not going to have problems once you're gone.
That is there's such helpful advice because there's somebody that I have in mind that's been putting off seeing somebody because, oh, I have to get this in order and that in order. And you just said, nope.
No,
That's what your job is.
that's what my job is. Yeah.
Okay. If you could please let people know how they could reach out to you, and also if you could do that in Espanol, that would be wonderful.
Oh, great, great.
Yes.
So yes, so they can reach out to our office at area code 805-482-2282. They can email me at M as in Mary, R at stakerrodriguez.com. It all runs together. And now in Spanish, si gustarían tener una consulta gratis conmigo, pueden llamar a mi oficina al 805-482-2282 o me pueden mandar correo electrónico a amr@stakerrodriguez.com. That's how you can get a hold of me. We speak Spanish and English here. A lot of times, children who speak English reach out to us, set it up for the parents. Once we let them know, hey, we can help your parents entirely in Spanish, because really this should be a conversation with just your parents and not you. It does take a lot of pressure off from the children, so it's a good thing that we do speak Spanish and can help folks in Spanish.
Fantastic. One last thing that you did not mention is For anybody in Northern California, you also have an office in San Jose.
Correct. Thank you for reminding me, Jeff. I
Yeah.
do. I have been seeing some clients and getting some business in San Jose, so I am available in San Jose. I oftentimes will do a remote consultation via Zoom or phone, and then the second appointment we'll do that in person, and I'll be in San Jose. So I'll say this in Spanish because I think a lot of my clients out there are Spanish speakers. También voy a San Jose una vez al mes o una vez cada 2 meses. Ofrezco consultas y voy a San José una o dos, o una vez al mes, una vez cada 2 meses. Y ya depende de las consultas que me queden para ayudarlos también en San José y las áreas alrededor.
Really appreciate your time, sharing your time and your expertise.
Thank you, Jeff. Thank you for putting this together. I appreciate the work involved in that, and it was a great conversation.
Thank you.